The two classes this week will be run online on Tuesday and Thursday. We're going to do, at least on Tuesday, we're going to do two of them. We'll see how that goes, and we'll play it by ear. And so there's a survey up that I hope everybody will complete by the end of, I can't remember when I've asked you to finish it, but whenever I've asked you to finish it, please finish it by then. And so we're going to change things a little bit from the syllabus. The syllabus says that we're going to do 4.7 and 4.5 on Tuesday, but instead we're going to do 4.13, and it's going to be part B. So this is a salesman, and so we can kind of look backward a little bit and see what he could have deducted under F and H, but really what we're going to do is move on and go, now what if he's completely self-employed? How does it differ? And then for now anyway, we'll leave 4.16 for the 31st as is on the syllabus. Also on the syllabus, there's a bit of a break in the so it has the first day 4200 to 4245, and then the second day 4250 to 4325. But really, the part that leaves out does not need to be left out. So just look at this reading for these 2 days as 4200 to 4325. Okay, so now to get a look, kind of an introduction to taxation of business as a whole, I wanted to look at a little scenario here. So say I have a young SAF grad, and this person is making employment income from some CA firm, and I have no idea actually what you guys are making these days, but let's just be modest and say 50. I'm assuming that's somewhere in the ballpark. So they're making $50,000 of employment income. But this young person is also incredibly passionate about the plight of honeybees. So I don't know if you followed this at all, but bees have been in a lot of trouble. And so what this young person decides to do is, I'm going to become a blogger, and I'm going to blog about honeybees and hope I can change the world that way. And so there's some costs, obviously, in time, but other things. So their expenses, his expenses for running this blog about the plight of honeybees, he has to buy a computer, obviously, because he needs a good computer, and he can't deduct the whole thing. But we'll just say that he buys a $2,000 computer and can deduct 30% of that this year. He also needs somewhere to do this, because Starbucks will kick him out eventually if he keeps showing up there day after day to do his blogging. So he needs to do that in his office. He also needs to know how to blog and to learn more about the honeybees. So he takes some courses, some education, and it's a fairly high quality, so he pays $1,000 for it. And then most importantly, he wants to be around other people who care deeply about honeybees. And so he goes to a couple of conventions that are in different places in the world and spends a fair bit of money getting there and being there. And so his total expenses are $6,300. Okay, so that's fine. He's spending a good chunk of his income on this. But why can't he run that as a business? What if this was a business? What if his blog was a business, right? So we've set it up so that it does look like a business. Well, on his tax return, if he wants to call this a business, then all he has to do is say, well, okay, let me just, all of a sudden, I didn't really think about this, but I have revenues of 0. Those were easy to add up. I have expenses here, so my loss is $6,300. Okay, so on his tax return then, he's going to have employment income of, what do we give him, $50,000, and he's going to have business income. In this case, it will be a loss, but of $6,300. So his taxable income then, if this is all his entire fact situation, his taxable income is going to be $43,700. And as it happens, in 2011, he would have paid 22% tax federally, this is just federally, on income over roughly 44. So he's going to pay 22% on that, and so he's just saved $1,386. So his tax bill goes down by $1,386 by saying, you know what, my blog is a business. And there you go. So the good people of Canada have chipped in $1,386 to help him run his blog. So why can't he do this? What's wrong with it? Well, the government, if your instincts are telling you he shouldn't be able to do this, you're right. And the government has said, or CRA, the Income Tax Act, says one must have a reasonable expectation of profit. Okay, and this guy who is has no revenue, it's pretty hard for him to argue that he has somewhat of a reasonable expectation of profit. So in this example, it's pretty easy to say that loss, that business income, that business loss of $6,300 will be denied. But this whole concept of reasonable expectation of profit sends us back to the whole world of case law and intention and all of those things, because we have, four words here. Reasonable is a word we've seen before, and it is at its best vague and hard to define. Expectation is about the future, so nobody knows the future. Of is the one clear word of the four, and profit is not defined in the act, right? So we have this idea of, what does it mean to have a reasonable expectation of profit? Does that mean I have to earn $1? Does that mean I can break even? Does that mean I have to earn a certain rate of return? If I invest $100, eventually I have to earn 5%, or I just was in it, I didn't have any reasonable expectation. It's not very clearly undefined. So, or it's not very clearly defined. Sorry. And so the CRA has come up with, as you see in your textbook in much more gory detail, these things that they call the general factors. So again, we're back into this place, just like residency, just like self-employed versus employed. We're trying to figure out how do we figure out if this particular business enterprise has a reasonable expectation of profit. There is no test that's going to answer that question for us. So the things that we look at are how it is operated. So does it look like it's being run as a commercial enterprise with the hope of one day making money? Is there a personal pleasure or recreation derived? And in his case, this is probably what would do our guy in the most, is that this is something, it's a hobby, right? It really is a hobby for him. Does he have any expertise in what it is that he could make money from? In his case, we don't have any history of him making money from blogging. Performance history, has the company ever made money? In his case, the answer is no. Now the interesting thing though here is that this whole personal pleasure derived or performance history, there are people out there who are making money on blogs. And there was a movie a couple of years ago about a woman who started writing a blog, and she sold her rights. The movie is called Julie and Julia, and she made a ton of money. And so we have these things out here where people are actually making money from their blogs, and so it's not completely impossible. The next thing they look at is how much time and effort do you put into this thing? Does it look like you are and again, some people are weird. They spend their time on things that other people wouldn't spend their time on. So none of these are sort of definitively defined for us. An interesting one here is the financial status of the person themselves. So if you have a lot of money, that can either work for you or against you, and saying, you know what, this thing is, you don't need to make money on it. But it could also go the other way, that you do have enough money so you can sustain losses for several years just to wait out until the profit comes along. So it can go either way, but it comes in. Size of occasional profit. So this is, when we look at the history, the size of the occasional profits. If you're going to lose money 10 years in a row, so lose $1,000 10 years in a row, but then make $1 million in the 11th year, that's a reasonable expectation of profit. It's just a very different revenue and profit stream than the norm, but it's still you've still made a good amount of money over 11 years. this other one, the next one is the continuation of the activity. So if you do something just for a couple of years and then give up, it makes it look less like a legitimate business. And then if you have done this other times, so your other success record, so there you go, your reputation is going to matter. If you have tried and succeeded before, you'll get more benefit of the doubt that this one is a business enterprise. And then the last one is the expected appreciation of, so we got the word expected in there again, but this is of the assets. So if you go into something, in his case, his only asset is the computer, and it's not going to go up in value. He's never going to sell that for profit. But there are other businesses where you can kind of go in and say, okay, we'll give this a try, but worst case is we're going to be able to sell our way out and minimize our losses because our assets are not going to go down in value. So anyway, there's the list, and it is again undefinitive in helping us determine. So you look at the case facts as a whole and say, is this business that we're looking at, does it have a reasonable expectation of profit? If the answer is no, then the Income Tax Act says go away. You're not deducting anything. We're not interested in what's going on for you. You cannot have those losses. But understand that most businesses have a reasonable expectation of profit. So these ones that are kind of half hobby, they make it a little trickier to figure out, especially these days, right? Because as I said, bloggers can make money, and bloggers can advertisers can pay to put ads on people's blogs, and all of a sudden you start to think, well, maybe someday this person won't lose. I mean, he only has to cover, what is it, $6,300 roughly. So if he gets a couple people to advertise, maybe honey producers to advertise on his blog, maybe he'll be profitable. So it becomes a little foggy. Anyway, for most companies, this is not a question. And so the reasonable expectation is a given. And those are the companies we're going to think about the most. And once it is passed, then the question becomes, well, what is deductible? So I'm going to spend a lot of money trying to make money. I want to know what is going to be deductible for tax purposes, because I'm going to know that I need to know what I'm paying out of pre-tax dollars and what I'm paying out of after-tax dollars. So in general, again, this is my paraphrase of summarizing what's in your textbook, but in general, if it is incurred to earn taxable income, and that is clearly defined as not a capital expenditure, then it will be deductible. If it is for your business, which is really, this is not that separate from the first bullet, but this one is noted here because, as we said, not personal. So it's tricky, right? Because we want people to do what they love and do what gives them pleasure, but it makes it a little bit more difficult when you entangle your business and your personal expenses, or things that give you personal benefit. It makes it trickier. It doesn't mean you shouldn't do what you want to do, and it'll get sorted out, but it does make it trickier. And then our good friend, reasonable. So no matter what, if you spend dollars and you spend $1 million and the expectation is that you could ever only earn back $20,000, that expense is going to be challenged, because it is not, people make mistakes, and people do that all the time. They spend $1 million and only make back 20. But if it looks like that was your intention all along, that you knew that the 20 was all you were ever going to make, then you are probably going to have some of those expenses denied based on reasonability. And then the last one is interesting. So if it's expensed in GAAP, so in financial accounting, then in general it will be expensed in tax. However, we're going to spend, and we already have started, we started last time, but we'll keep going with many specific exceptions. So with many specific exceptions. And most of these differences, as we've talked about, are differences of timing, but they matter. So it's not that GAAP and tax disagree entirely. They disagree on the timing of when these things should be deductible. But in general, again, we're going to look at them. It's going to look like, boy, tax and accounting never get along. But we're going to be looking at the things that they don't get along on. They're on most things. If it's expense for GAAP, it will be deductible for financial accounting, and that, or for tax, sorry. And that's why we start with financial accounting net income as our starting point for getting to taxable income. So next, on the next video before Thursday, we'll look at some of these very specific things. But for now, we'll leave it at there. We'll leave it at that.